Hi, I'm Joe Ezernak, and I'll be your host for our June video newsletter. I want to jump right in and talk about the year-to-date return of the S&P 500. And to me, this is a pretty remarkable rally. And the reason I say remarkable is because, well, it's had a really great start to the first half of the year. However, there are a slew of negative data points that are highly correlated to recessions and bear market type returns. I've listed a few here on the right, but I do want to go and highlight one of these, go a little deeper into it, and that is the leading economic indicators, or the LEI. The LEI in this chart is represented by the blue line. And here's where we are today. At this very negative level, historically, this has always been associated with a recession. This time, it may be different. I don't know. But what we do know is that the S&P 500 has been very resilient in the face of a lot of negative economic data. What we can do is look under the hood a little bit and see, well, what is the driver of that response to the negative economic data? I believe the primary factor contributing to this is the Federal Reserve's continued manipulation. This chart illustrates the S&P 500 red line alongside the influence of the Fed's monetary policies on the stock market, blue line. And this is a very clear visual correlation. If the Fed is easing, the market goes up. If the Fed is tightening, the market goes down. Easing, the market goes up. It appears that the Fed has recommitted to their path of quantitative tightening recently after their small bump to help us out of the banking crisis. If this continues, I believe it's going to make it more difficult on the general stock market to continue posting new gains with very low volatility. So if this continues in the next quarter, I will expect more volatility from the market and very likely a pullback from its most recent highs. Looking back at June, there was a very major headline that was generally good news, and that is the passing of the debt ceiling bill. It's always good news when the U.S. does not default on its national debt. However, with a national debt above $32 trillion, are we having too much of a good thing? Is this healthy? Is this sustainable? Well, I want to look at a few context clues, kind of help us form an opinion. Right now, the U.S., our debt to GDP ratio is at 121%. Globally, we are a top 20 for the highest debt to GDP ratio. And to put that into a little bit of context, at the end of last year, we were only 5% lower than Venezuela. That doesn't sound very healthy to me. How long can we sustain this level of debt? I really don't know, but what I'm fairly certain of is that we can't do this forever. So what happens next? I don't know. And please check out Don Beasley's series on timeless math. It's always entertaining. Thank you.